September 29th, 2008. Imagine you wake up, hop out of bed, make a cup of coffee, and get a call from your seemingly worried friend, screaming at you to check the stock market. With a pit in your stomach, you click log in, only to find that your life has been turned upside down. Stocks had dropped a devastating 778 points. Your stock market investments have gone down to the point where they are basically worthless. This is a situation many Americans faced in the financial crisis of 2008, the worst financial crisis since the Great Depression. And even those Americans who hadn't invested in stocks still felt the effects when many of America's largest banks, such as Lehman Brothers and Bear Stearns, filed for bankruptcy. When these banks fell, it became almost impossible to get a loan for anything. Home sales, car sales, and all other large purchases became stagnant. The whole economy was affected by the lack of cash flow. People began losing jobs left and right. The unemployment rate increased by 4.5% between 2008 and 2009. That's 8.4 million jobs that were lost. But what caused this mess?
What caused the banks to fail? The answer is subprime mortgages. Subprime mortgages are home loans that were approved for people with very bad credit who really should not have been allowed to purchase the homes that they were approved for in the first place. These loans were approved because India, China, and Russia opened up and invested in the U.S. economy. These investors essentially helped pay for the homeowners who were not able to pay off the loans that they were given. Financial markets failed because banks became bankrupt. Therefore, almost no one in America was taking out loans to purchase things, which affected almost every market. Even though the recession technically started towards the end of 2007 and ended in 2009, the effects are still being felt today. The unemployment rate was about 4.9% and has just reached 4.9% in today's era. This means it took a better part of 8 years for the employment rate to return to what it was before the recession.
I'm Carolyn Weber.
Let's get it started here with what was your first job in 2007? What was your job in 2007 during the crisis?
I was a real estate broker.
Okay. Can you give us a little bit of background on how this happened? A little precursor.
Well, we had an all-time high in the early portions of 2000, and as we had an all-time high, we overinflated the pricing of our homes, and people took out mortgages for values on their homes that in the end, when they went to sell them during 2007, 2008, their values were actually lower than those of the mortgages that they had on these homes. So in essence, they were upside down in their homes. They couldn't get out of them for what they owed on them because their value was not as high.
I see. Do you remember where you were when you found out that the market had gone for an all-time low?
I remember where I was. It wasn't one particular day. It was a culmination of a number of different events that brought it to a head.
What was the event that made you realize this country was in deep trouble and we needed to fix what was going on?
The foreclosure rate was out of control. Absolutely out of control.
I see. So how did this affect your career?
The housing market went through the floor. No one could get out of their homes. We had short sale. We all had to be retrained in short sales. If you didn't understand what a short sale was, as an agent, you did through that crisis because there were so many people in existing homes that had to explain short sale, had to sell their homes short of what they owed on them, and the banks were willing to take that hit because that was the only way they could get out of the mortgage that they had their client in.
I see. Did it affect your personal life at all, like your home life with your kids and?
There were a number of people around me, a number of friends, family, that were in the same situation as my clients. They were forced to short sell their home, and if they couldn't short sell it, I knew many people that foreclosed, and it was heartbreaking.
Was there any specific banks that you remember that you once they went under, you just were surprised and?
Oh, there were hundreds. There were hundreds. At the same time that I was a broker, I also worked for a company that appraised the value of small businesses. And by working in that industry, I worked with a number of different banking institutions. And the banking institutions that we normally worked with all started to fall by the wayside. They went under one by one. And only the big guys were saved. The Chases, the Wells Fargos, those are the guys that ate up all the smaller banking institutions.
Excellent, excellent. One last question for you, Carolyn. How do you think the market is faring nowadays?
Here in Denver, we're in an upslope because we have so many incoming residents. Denver's turning into one of the prime spots in all of the United States as one of the prime locations in living circumstances. And we are in an upslope because of that increase in demand. So our real estate is doing exceptionally well right now. Buying a house, you still have very low interest rates, which is great, but yet you have quite a bit of choice out there in terms of existing homes and the newer homes that are being built to accommodate the population increase. So our market is on an upswing. Those homes that were in that crisis, if those people were able to hold out during that period, they're now able to see their houses start to increase in value once again. If they were able to hold through that dip that we had, we're now seeing that rise. We were at 10% a year. At that point, we lost a tremendous amount of that value, but it's now coming back.
A huge setback for America's economy, the financial crisis of 2008 affected nearly every family living in the United States.
And will go down as one of the worst recessions America has ever experienced.